Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. What a day yesterday. Ugly day in US stocks. Banks got completely trashed on contagion fears around the Silicon Valley Bank. We'll talk a bit more about that in detail. European stocks closed unchanged on the day, but have opened weaker by about 1% to 1.5%. Obviously, the sell-off really happened after the European session. And then China also continued to slide down about 3.5% on the day by the close. VIX had its biggest pop in months as true fear seems to be coming back to markets. Anytime there's fear about a credit event, generally VIX tends to spike. Bonds catch a bit of a flight to safety bid, and those are the type of things we've been seeing. In commodities, energy was weak again, with nat gas and oil both lower, but gold did catch a flight to safety bid, bouncing around about 1%. And kind of decoupling there from the likes of copper and silver, which really weren't particularly up on the day. So volatility-wise, US vols ratcheting higher. You can see here about 2 to 3 vol points across the main US indices. Europe was more muted, but really the move didn't happen until after. And China vols also higher. But look at VIX. VIX vols up 25 points. VIX spot up in the 15% kind of range. Really a huge spike there, kind of catching up to the move index. There was a big divergence between the move and the VIX. I was of the opinion that spread would get closed via the move coming down post all the events over the next week or so. This kind of came out of left field, this little bank run. And so obviously it's closed that gap the other way with the VIX spiking. Positive carry mainly across the board in equity indices as those implied vols go up, and the moves down, whilst the market did look ugly, the moves down are kind of in the 1 to 1.5 sigma type range. So we're not getting like 3-4 sigma moves to the downside, which would flip all these carry numbers to negative. So at the moment, for now, carry still seems to be positive, but if we look backward looking. But I do think a break below 3,900 on the S&P could easily change that dynamic as we move into more deep short gamma territory, and the VIX will also go into short call territory for March expiry, where a lot of those big calls that have been bought in the 24 to 30 range on VIX, they could really start to get spicy and drive some more upside on the VIX if things start to turn ugly. Skew wise, we did see a rebound in S&P skew, 3/4 of a vol there, taking it back to the 30th percentile. S&P does tend to be the first skew to catch a bid when something like this happens because of the liquidity that is available in S&P puts. And obviously VIX upside as well. You're seeing a repricing of VIX skew now looking at like 46 points, and that's a 25 delta. That always is for calls above puts, and that's VVIX and VIX spiking there together. In terms of commodity skew, bit of a mixed bag. Copper flipping back towards put skew as things just generally deteriorating in the macro space. And then silver skew continues to head lower, back to neutral, as we've been flagging that it was looking quite expensive for puts. Okay, so let's talk a bit more about this bank run and what's going on with this Silicon Valley Bank. So it suffered a 60% drop on the day. It's also down another 30 to 40% overnight on solvency concerns. As prominent VCs recommended pulling deposits from the lender after recent turmoil at things like Silvergate Bank obviously failing. That was the crypto bank. But basically, the kind of contagion, the idea that a lot of the assets these guys hold have got big negative mark to markets, and there's solvency concerns. So when a bank run happens, banks that don't have enough liquidity have a problem. And then the fears kind of spilled over to the entire sector. So you had JP Morgan shares down 5% on the day, and the sector itself, XLF, having its worst daily drop since 2020 of around 4%. Now, if we look at the actual regional banking index, KRE, that was down even more. I think it was like 6% plus. And if you look at put volumes on that index, KRE, on that ETF, they absolutely exploded to record highs. So this chart down here shows us daily put volume. We're talking about 500,000 puts trading in KRE, which is a record if you go back on that. And the idea being there, investors kind of rushing to hedge the downside tail against what looks like another potential Bear Stearns type credit event. So rates markets responded with a flight to safety bid. Yields rolled over, particularly in the front, taking back much of this week's gains. after Powell's hawkish testimony to Congress. Gold, obviously, we said fared well as a safe haven asset, and the VIX had its best day in months. Non-farm payrolls today, while still important for the Fed's reaction function, we do think may have to take somewhat of a back seat as this banking crisis story unfolds over the weekend. Generally, these things kind of exacerbate into the weekend, and you're either going to get, things getting worse or some sort of restructuring or bailout as people like Bill Ackman are talking or calling for from the government to prevent this thing really having a lot of contagion into other parts of the market. So there's quite a lot of headline risk in both directions, right? So kind of look out for that, and it's probably going to keep volatility quite high over the weekend. So I don't expect any kind of material reset involved after non-farms like we may have got if this hadn't have happened. All right, so let's look at the XLF. This is a chart of the XLF with a bit of volume profile on there as well. So you can see it's been quite a dramatic collapse, right? You're looking at 36 and a half where we were. We've pretty much dropped 10% in short order in like a week. So we're down here at around 33 and a half. Now, if they do manage to contain the fallout from this SVB financial business, then there could be a snapback trade here, and we could move back into maybe this kind of area where there's Fibonacci confluence zones. So looking for maybe something between 34 and a half and 35 and a half in a bounce. And that bounce, it could be quick, or it could take, a few weeks to digest this move and go back up there. So we're thinking, it's always dangerous to try and catch a falling knife in this stuff. But we don't necessarily think that the big banks are going to get killed on this. And this probably does get contained at some point. So the nice thing about options is that they allow you to kind of safely buy the dip if you know what you're doing. Okay, so we know that vol's exploded by 6 points. We know that mean reversion of vol generally means that this vol can fall back if markets stabilize. So how do we best sort of capture that, and how do we capitalize that? So looking at our vol dashboard, obviously big spike in vol, but it's telling you to sell puts. I mean, that's for the suicidal. Probably wouldn't do bullish risk reversals or put sales right now because you don't really know where the bottom is in this stuff. So whilst it does look like a nice drop and it's kind of pretty much approaching those lows that we saw back end of last year, who's to say we can't break that and go even lower? So selling puts is a no-no for me. It's a bit risky. Okay. We had nice drops here in spot, big drops. So if you want to buy it, look at what the curve's done. The curve's popped pretty dramatically. Now, I wouldn't really play around too much in the 1 week stuff. Generally, when you sell vol, I want to sell something with a bit more meat on it, with a bit more Vega on it. So going to 1 month expiry, I think makes sense. So something to April. You can see here the vols have spiked, so the vols have got room to come back down. So what do we want to? How can we play a trade that sells a bit of vol, plays the upside? Well, the type of trades we like doing there are call ladders or call ratios. This is where we can, spend a fixed amount of premium. The market continues collapsing to the downside. The most we're going to lose is our fixed premium. All right, that's it for today. Non-farm, look out for non-farms, but like I said, I don't think it's as much of an event as it was. And I'll catch you all next week. Cheers.